I really think that this inflation regime is a different one than in the past. If you look at a chart of the core PCE from the early 90s till now, it has basically been range bound between, call it, 0 and 2.5% that entire time. So what did that enable the Fed to do? It allowed the Fed to paper over every single financial crisis with monetary stimulus. But then you look at that chart, and all of a sudden, this time around, boom, that core PCE is almost near 5%. To me, that changes everything. That changes everything. Unless they willingly move the goalposts, which they have explicitly said they will not do, it does not allow the Fed to come to the rescue in the same way it has done for the last several decades.
On today's episode of the WTFinance podcast, I'm happy to welcome Michael Kao, who's a private investor with 30 years experience in the markets and author of a great newsletter, which I highly recommend, which is the Kaoboy Musings. So Michael, thanks for joining the podcast today.
Thank you for having me.
No problem.
Appreciate
I really look forward to our conversation. We were just saying before, we definitely have a lot to speak about. It's been one of those crazy weeks.
No shortage of topics, that's for sure. I feel like I've
Yeah.
been talking incessantly since Sunday.
Yeah, exactly. Lots of content out there now. But it is the classic. I was
And
away on.
Sunday seems like eons ago at this point.
Yeah,
Boy.
literally. Oh well, you never know. It could get worse, but we'll see. So, yeah, as I said, the past week there's been an array of bank failures, I guess, throughout the US. That obviously there's different reasons for them to happen, and there's a concern that this could happen internationally. We've seen Credit Suisse. There's lots of concern there. What are your thoughts on the current situation and what's really unfolded?
I've been saying that even before this whole BTFP facility came out, my prediction was that the inflation fight here at the Fed is too important of one to derail, and that I predicted on Sunday, I think, that they would come out with a surgical tool to ring fence this contagion without having to sacrifice its inflation fight. And in fact, that's exactly what's happened. So I liken this BTFP facility to something like a controlled burn, if you will, that allows, it's liquidity at a price. It's a bailout of the depositors, which 100%, which I actually don't agree with in that. Well, it's nuanced. I would say that I don't think it was right in this case, given how idiosyncratically badly managed this bank was, both on the asset side of the balance sheet and on the liability side. So if you are an uninsured depositor to a bank, you are basically an unsecured creditor. So if you're lending money to somebody, in this case, a bank, I think you should at least do a modicum of due diligence. And when you look at the confluence of, a huge amount of something like 97% of deposits were uninsured because they chose to bank with very large institutions that would just park hundreds of millions of dollars of cash there. But that's fine if you have very, very well managed assets. But this particular bank also was reaching for like an extra 40 basis points of yield, deliberately chose to not hedge its interest rate exposure at the top of the market, right? And so I think that it's a very idiosyncratic situation. It was an idiosyncratic situation in the first place, and even though it's impossible to prove a counterfactual, I think even had depositors gotten a haircut, this thing would not have metastasized as badly as some people think. But obviously, it's impossible to prove a counterfactual. That said, bank runs can careen out of control. And if there's one lesson that the Fed and the FDIC and the Treasury has learned from the experience of 2008, is the importance of having consistent policy. Because one of the things, if you remember back in 2008, even a week before the Lehman Brothers failure, there was the sudden conservatorship of Fannie and Freddie, when in fact it really was not necessary at that point. There was the forced shotgun wedding of Countrywide, but then they seized WAMU, and WAMU had a far stickier deposit base than Silicon Valley Bank, and they weren't even really experiencing a run, but they got seized, and then they wound up choosing to save Wachovia. So there was all this inconsistent policy, and so even though I find this BTFP facility somewhat repugnant in that it does create moral hazard, I see the need for it, but I also said all week I've been saying that this BTFP should not be a BTFD signal for risk assets generally, because it does not mean that the Fed is all of a sudden going to risk the entire inflation fight that it's been trying to do for the last 15 months. And so when you take a look at Christine Lagarde's decision this morning, right, the European economy honestly is on much more fragile footing than the US economy, and yet they plowed ahead with 50. I just don't think the people that are calling for no cuts, or some people are even, no hikes. Some people are even calling, I believe the Nomura guy was calling for like immediate cuts. I think there's almost zero chance of something like that happening. So yeah, it's a very strange market, because one of the risk markets, when you look at equities, when you look at Bitcoin, they're all kind of heralding this. It's almost like we're back to QE mode. I think we're far from it. I tweeted an interesting chart today, courtesy of my favorite macro analyst, Lakshmi from Capital One. And it basically just shows how when you look at core PCE versus the Fed funds rate since 2006, from the 06 to 08 period, you had real restrictive rates, because you had basically Fed funds at around 5.25-ish, and at that point the core PCE was only like 260, something like that. Okay, so that's a real restrictive rate. Here she called it, we're still in YOLO zone here, because you basically have FFR right now not even at 5%, and that core PCE is still above that. So I just do not understand the mentality of the people saying, oh my gosh, something's broken. No, something has not broken, especially with this surgical tool that they just rolled out. So that the trade-off between price stability versus the inflation fight is simply not here. It will come, make no mistake about it. I'm not being a Pollyanna at all. I think that the whole point is to get, the Fed has previously signaled that it wants unemployment to tick up to 4.6%. But I have news for you. If unemployment is up at 4.6%, we're talking about a job loss that the Fed is willing to tolerate of about 1.5 million to 2 million, not 20,000 or 200,000. So we have a long way, a lot of wood to chop to get there. That's my view.
Yeah, it's crazy thinking. You mentioned there that they're sort of bringing out these scalpels, and we're seeing to try and fix these issues rather than the overall interest rate reduction. So you said the ECB 50 basis points increase, and yet one of the largest banks in the world, Credit Suisse, has just got a $50 billion loan on the same day. It's hard to imagine how those two things can work together, but they are. So do you think is there a size of bank or a size of like a bailout that won't occur? Or do you think they're willing to do whatever it takes to save these banks if there are any issues in the future?
Who's they? Are you talking about Europe or in the US?
Either or do you think it's different between them?
Again, I do think it's. I'm not an expert on the European banks, but my understanding is that the the U.S. banks, at least the money centers, are in much better shape than some of the European banks. But I think that, again, speaking for the U.S. banking sector, I really think that the epicenter of the next crisis is not going to be in the banking sector, at least here. I think they've figured out very quickly by rolling out this consistent policy response that's surgical, okay, that they're going to ensure that it's not in the banking sector. But where are the hidden icebergs? I've been saying this week that I think the true risks have been pushed out to the shadow banking sector. And what do I mean by that? You think about the world of financial intermediaries, ranging from mutual funds, asset managers, hedge funds, venture capital funds, private equity funds, even universities and endowments. These are all part of the shadow banking sector, right? And the degree of asset liability mismatch is different. With the banking sector is the most fragile because the depositors are the lenders essentially to the banks, and they have daily liquidity or instantaneous liquidity, right? And that's why, and these surgical tools have been designed to figure out how to ring fence that. But I've lived through, as a hedge fund veteran of 25 years, I've lived through my own harrowing experiences, right? Back in 2006, for instance, there was a hedge fund called Amaranth that blew up due to, just call it style drift. They were supposed to be a convertible arbitrage shop, but they were trading in natural gas futures, right? So they blew up, right? But there was a fund of funds that was one of my big LPs. This was a $4.5 billion fund. They had been promising their own LPs 30-day liquidity, but they were invested in quarterly and annual liquidity managers like me. Well, all of a sudden, because of the fallout from Amaranth, they had a rash of redemptions that they couldn't meet in 2007. And so they had to basically put their entire fund in liquidation and basically redeem from all of their managers, including me. And it was a really tough situation for me to deal with because it careened also into the 2008 situation. It's a rough period. So that's an example of how an asset liability mismatch on the hedge fund side can happen. Here's how it can happen on the venture capital or the private equity side. Those tend to be longer lived vehicles, right? And so they're not going to have the same short fuse as hedge funds. However, given the negative credit impulse that's sure to come of the Silicon Valley Bank collapse, right? I would expect that a lot of the venture funds are going to have to write additional checks to support their startups that are now starved of capital. Well, they're going to be issuing capital calls to their LPs. Who are their LPs? Well, other parts of the shadow banking sector, like endowment funds, pensions, teachers' retirement funds, what have you, right? But I bet these financial intermediaries, in turn, right, are suffering losses elsewhere. So this is going to be what I am on the lookout for, because I think that part of the financial system is far more opaque and less regulated, and something will happen there. I certainly won't be surprised if there's a big blow up. So to me, this current setup is much more similar to the Asian contagion of 1998 than the great financial crisis of 2008. In the Asian contagion, right, you had a situation where you had a strong dollar, right, as we do now, that eventually spurred a whole bunch of successive devaluations in very weak emerging markets, starting in Thailand. And then I wrote a thread about this last year in August, calling it, "Are we on the precipice of an Asian contagion 2.0?" Because from that period of summer of 1997, it took a year and a half before the domino effects truly got felt. and they culminated in the spectacular blowup of LTCM, which was a hedge fund, super levered hedge fund, that at that point had so much counterparty risk that it was deemed too big to fail, and it required a concerted sort of bailout. So something I could see something like that happening, but I really feel strongly now, even more than before, especially after this BTFP facility got rolled out. I don't think the problem is going to be in the banking system this time, at least not domestically.
So would you say in terms of the assets that will probably be most at risk and probably see the most drawdowns, those are liquid ones? You could say, potentially real estate as well. You've mentioned a few there, private equity, those ones where there's these funds built around them based on money that could be withdrawn and they just can't match up with the withdrawals. Is that sort of your thoughts?
Yeah, I mean, well, I will. I have a pinned tweet right now where I think one of the biggest Achilles heels is for the entire global financial system, and I actually think it's China. If you want to talk about like the ultimate sort of Ponzi finance that's happening, it's actually China, because China, there, a lot of people tout the relative low debt to GDP of their sovereign balance sheet. The problem is that it is all a facade, because when you look beneath the covers and you look at how much debt has been stuffed, quote, off balance sheet in the state-owned enterprises, in the LGFVs, in the property developers, right? What you've got, and in my Substack thread, I wrote about, and I cited multiple sources, but this one interview that's really bone chilling. I had to listen to it 3 times by this guy named Andrew Hunt. He basically did some forensic analysis of like 36 Chinese banks, and he found that there's as much as a $3.5 to $4 trillion gap between the true liability and what's captured in the official balance of payments data. And so essentially, these banks have borrowed short in US dollars to fund illiquid projects, in many cases insolvent projects, in their property sector and in failed One Belt, One Road initiatives, right? So you've got a currency mismatch, a duration mismatch at a time when the Fed, as we've just talked about, I don't think the Fed is done hiking. And then you've got this situation where China's economy is very, very export dependent. So you would think, right, that they would want a weaker yuan, right? But if they have a weaker yuan, right, they also have this funding problem, right? So they, as much as the Fed is walking a tightrope, many think of facing difficult choices, it's infinitely more difficult for other central banks around the world, especially the PBOC, I would argue. But look, even even in the ECB's case, right? The ECB has the additional problem of trying to hold the whole system together of all these various sovereign countries. I mean, the whole TPI mechanism was established to try to just keep these spreads from diverging. And so I guess my point is that if Christine Lagarde could go 50, I don't see how there is a world where the Fed is all of a sudden going to cut. So I think there's a big rug pull coming to a number of asset classes. I really do. And then the other tell, right, is look at the Bank of England when they had their gilt crisis at risk of blowing up their pension system. What did they do? They had a temporary intervention in the gilt market, but they continued to hike. Now, the UK economy is way more fragile than the US economy at this moment in time. They're already straddling the zero bound on GDP when the US's economy is still got a head of steam to it. All of the local data, whether it's unemployment or housing starts or the core PCE have actually experienced an upturn again. It's not going in the right direction. So for all the talk about the long and variable lags of monetary policy tightening, I suggest reframing it. What about the long and variable lags of decades, not years, but decades of endless liquidity lottery? They're still being felt. So I really think that this inflation regime is a different one than in the past. If you look at a chart of the core PCE from the early 90s till now, it has basically been range bound between, call it, 0 and 2.5% that entire time. So what did that enable the Fed to do? It allowed the Fed to paper over every single financial crisis with monetary stimulus. But then you look at that chart, and all of a sudden, this time around, boom, that core PCE is almost near 5%. To me, that changes everything. That changes everything. Unless they willingly move the goalposts, which they have explicitly said they will not do, it does not allow the Fed to come to the rescue in the same way it has done for the last several decades. And to me, I think that is the biggest risk of the current regime that we're in.
Yes, it's crazy to think, as you said, it's really a duration issue that most people have borrowed short term, lent long term. That you said the same thing with pensions. They had the same issue that we've seen in the US recently. So, is there a way that they can get out of this? We've mentioned that probably SVB probably should have hedged. They should have had better risk management. Is there a way that these institutions can get out of the situation they're in without the Fed loosening, which obviously you don't think will happen, or are they? Is it just inevitable?
Well, unfortunately, I think the way this banking situation is going to resolve itself is that the too big to fail banks will become even bigger. I really think that's ultimately going to happen, right? And here's the other thing, right? So on a day like today, with the announcement of the liquidity that Credit Suisse is getting, right? And also just from the sigh of relief from the BTFP facility, you're seeing big rebound in the financials. I want to also wave a flag of caution there, because if you remember back to the global financial crisis, right? These shotgun weddings between banks, they're very punitive. They tend to be very, very punitive to investors. So it's sort of like, be careful. This BTFP facility is one in which I love Greek mythology, right? So I kind of think of it as, okay, be careful, because if you accept what happened when Persephone accepted the pomegranate seeds from Hades, she can't really leave Hades. Well, except in her case, her mother kind of negotiated for a seasonal return to the regular world, right? But my point here is that this facility comes at a price, and so it's not at all clear to me that these shotgun weddings are going to be beneficial for the prices of some of these beleaguered banks. Could be quite the opposite, actually.
Yeah, definitely makes sense. So, if we look at, you were mentioning there that you think interest rates will be higher for longer, and then inflation will be higher for longer as well. What is the reason behind that? Why do you think? Now, I've heard you say before that you think going in the future there will be a supply issue for many things, but can you go further into that?
Yeah. So I have a fair amount of background in the oil and gas space, And what I can tell you there is that there has been a dearth of capital spending for a long time now, ever since like this last cycle. Really the last bear cycle started and lasted between 2014 and call it 2020, right? And again, the sector that remember that in 2007, 2008, oil prices had gone up to about 140 before the world economy collapsed, right? And then oil prices had gone back up to above the $100 mark. And before what happened? The shale revolution happened. Now, the shale revolution was a very unusual confluence of events, very unusual in that the ingredients that came together are highly unlikely to coalesce together again. What were the ingredients? Private ownership of mineral rights, which is pretty much a US only phenomenon. Of course, you need shale deposits. That's not a US only phenomenon, but you also need good infrastructure, water offtake infrastructure, right? Which tends to be a US or a North America phenomenon. For instance, Argentina has great shale reserves, but they have terrible governance. It's a socialist economy, number one, and number two, no infrastructure. And then we had a ton of cheap capital. Again, that's gone, right? And then also back then there was no ESG mandate, and so the confluence of all of these things have now led people into this false sense of security that we were producing at 13 million barrels per day at COVID, and you know what, we'll easily get back to that level. No, we won't. The shale oil accounts for 75% of the U.S.'s production, 12.5 million barrels per day. The Permian, which is the most prolific part of shale, is about to peak in 2024. So imagine the following scenario. Let's say we believe the yield curve that Jay Powell is going to blink and all of a sudden go back into QE, monetary easing by the end of this year. Well, the Permian will be peaking around that time, right? If that happens, and then the world economy starts getting juiced by a coordinated return to easing, we will reach what I call the supply-demand singularity point, where demand eclipses all available spare capacity. You see, this is what's interesting. I think the long-term supply curve, longer term, meaning like next 5 to 10 years, okay, of oil is getting more and more inelastic. I've been bearish in the short term, primarily because I see the negative feedback loops of global coordinated hiking and a strong dollar reduce the aggregate demand curve, right? So if you think about it, if you have an inelastic supply curve that's getting steeper and steeper, even a small change, a downward shift in aggregate demand will result in a very, very violent negative price shock, which is what we're seeing and which is what I've been forecasting since summer of last year, right? However, imagine the following scenario. During that period of time, the supply curve becomes even more inelastic. There's less projects being invested in. Maybe if oil prices go low enough, maybe even wells get shut in, okay? So that curve gets even more inelastic. Just when a hapless Jay Powell goes full-blown easing, well, then now you have even a more vertical supply curve, and now the aggregate demand curve shifts up. And this time, I think oil won't stop at 150. It probably goes well north of that. So the mitigant to that thesis, okay, there's a mitigant to that thesis, and there's a mitigant to the mitigant. The mitigant to that thesis is that because of terrible policies on our part, we've gutted our SPR and essentially transferred it over to China. So if China's got anything going for it, is that they have been stockpiling our strategic petroleum reserve, essentially, which just makes me very angry as a citizen. Okay. So if oil prices do spike, right, maybe China is the one that releases its SPR to dampen oil prices. The mitigant to that mitigant is that even though that China's SPR capacity is bigger than ours, when you consider it in the context of a population that's 4 times the size of ours, it's really not that big. So it's a complex interwoven macro web we live in, that's for sure.
Yeah, that's fascinating. So when from your perspective, I know it's very hard to know. When do you see that singularity occurring? And would this just be in the energy market, or do you think this will be on all commodity markets as well?
Well, so I think, so I started writing about oil. I really first started tweeting, period, in early 21, and I wrote a thread in early 21 talking about how this commodity inflation butterfly has big wings, and that because oil is such a critical factor of uh, uh, a factor of input for so many industries, right? Petrochemicals, transportation, right? It ultimately feeds inflation in other sectors. And in my mind, that's exactly what happened. So like back when I started writing about this, the zeitgeist of the moment was still very much, this is all a transitory inflation. And I had been saying at that point, not from where I'm sitting, this is not a transitory, this is a structural, this is really a structural thing. Sure, there were transitory issues. And here's the other thing, right? What happens when transitory issues keep resurfacing? Are they truly that transitory? Because with the supply chain disruptions, right, you could argue that that's part of an ongoing structural process of an increasingly deglobalized world, with also negative demographics that ultimately could be inflationary from a labor standpoint, especially as China loses its working age population, right? So there are many reasons for me to think that even the so-called transitory supply shocks are really not that transitory. But I focus on oil because I think oil is the linchpin commodity of the world, despite what the folks in the Gretaverse would have you believe. I think it will be, energy transitions take decades, and I think sometime within this decade we will have an issue, and the fact that it should not be soothing to anybody here living in the United States that our SPR is down to essentially levels not seen since 1981. And, I mean, the whole reason for establishing the SPR was in response to the 1973 and 1974 Arab oil embargoes. We haven't even seen a geopolitical disruption yet. So, God forbid that we actually see one.
Yeah, it's scary to think. So, say if we do experience this, as you said, it's going to be a very inelastic oil market. It's going to be potentially lots of volatility. I'm sure big jumps, big decreases in the price.
By the way, I want to add one more point to the inelasticity argument. What I find really interesting right now, and part of the reason why markets are so volatile, is that inelasticity argument, while I know it really well for oil, I kind of see the same thing happening in multiple other asset classes. You could talk about crypto, Bitcoin, right? There's this built-in supply inelasticity due to just lack of supply on built in. You could talk about equities because of this heavy passive element, right? And then you can even talk about bonds and the dollar itself because of this shortage of collateral issue. And so my observation is that when I look at these crazy gyrations in both directions, I say to myself, you know what, maybe try not to read so much into forceful price moves as you might in other regimes, because there's this element of a supply inelasticity that's exacerbating the moves. And so you can have violent moves. I personally, from this observation, would expect to have to see violent moves in both directions, and not be so wed to the fact that, oh my gosh, this must mean some kind of regime shift. Well, no, it doesn't. It just means that when you've got built-in supply inelasticity in multiple markets, you have a very, very fragile system subject to high vol.
Yeah, definitely. And definitely feels like we've experienced that the past few years. And yeah, it's something that, as you said, we probably have to get used to. So, in terms of assets that might perform during such a period, what are you thinking? And I guess you compared it to like 88, sort of the Japanese crash that we saw there. What assets?
98, yeah. Well,
Yeah, so
the good thing is that you know there you don't have to be chasing anything right now, because if you've got T-bills that are rewarding you close to 5%, right? I mean, honestly, that's been by far my most aggressive personal asset allocation over the last several months. And then uh, I have some idiosyncratic equity exposures, but they're really quite tiny at the moment. Um, and honestly, I'm more bearishly positioned right now. So a lot of people like gold. I'm kind of ambivalent on gold. I can understand the reason why people want to hide in gold. My problem with gold as a trade is that I call it the chameleon trade. It tries to be all things to all people all of the time, right? Sometimes it's a flight to safety, which I think is kind of how it's behaving right now. Sometimes it's a hedge to inflation expectations. Sometimes it's just a pure sort of inflation capacitor like Bitcoin, where I feel like it's a vehicle that sops up excess liquidity. And then right now there's also this X factor where certain central banks that have been sanctioned by the U.S., like Russia, have no choice but to stockpile gold, right? But the problem with all of that is it's kind of like it's what's the investment thesis exactly? It's hard to falsify any sort of investment thesis there, and it's also an asset that you can't value. So to me, it makes it very, very problematic for me. So yeah, I actually prefer, if it's safety that I'm looking for, I would rather be in T-bills. Um, and I'm looking for an opportunity to deploy uh, high conviction bets, but I have to say, I think valuations to me are nowhere where they need to be to convince me that we have uh, fully rinsed this cycle. Kathy Ark is still getting inflows. I mean, I think before this cycle is over, you need to see multiple things happen. You need to see a full rinsing of some of the excesses of the cycle. Um, uh, and that's not going to happen if at current valuations and embedded expectations. I mean, the market, and when I say the market, I'm talking about multiple asset classes now, not just equities or Bitcoin. Multiple asset classes have been inured by the recency bias of the last several decades. Right? Most people, when they think recency bias, they look back, oh, 12 months, and then okay, all right, I'm gonna look at the big picture and then go back 5 years. No, we have been lulled to sleep by decades of liquidity lottery because of the lack of structural inflation. That to me is the biggest source of potential rug pull, is that this time the Fed cannot paper over an economic crisis the way it has done in the past because of the presence of structural inflation.
What would you be watching to think that, obviously it's impossible to get the bottom, but what would you think is when we get closer? Will it be due to, certain indicators you're watching, or what will you be watching for specifically?
Watching for like when they might pivot, when they might actually
Yeah.
pivot.
Or just in terms of you deploying capital. So you say valuations, is that going to be a key metric that you're looking at?
Well, valuations for sure. But I think, okay, so for me, the real identification of when the trade-off comes is when you really have a spike in unemployment. And that just hasn't happened. That just has not happened. I think it'll come. But see, this is the problem facing the world right now, right? Every central bank in the world is hoping upon hope that what the Fed has done so far will basically cause a global worldwide recession, because then the ECB doesn't have to do its hard job. The BOJ doesn't have to do its hard job. The BOE doesn't have to do its hard job. And the PBOC doesn't have to do its hard job. The problem is that the US economy is still sporting 3% GDP growth and 3.5% unemployment. That's unmatched anywhere in the world right now, right? And so I last year I noticed this dichotomy, or not dichotomy, but this the lack of synchronization of macroeconomic cycles. And I wrote a thread called, sort of geopolitical mosh pits, because that's where we are at, right? The fact that we're out of sync and everybody's got their own domestic inflation problem means that there's going to be kind of an every man for himself dynamic. Now, there's going to be some coordination, a little bit, but to an extent. So I'll give you an example. June of last year, when the yen started breaking down to 145, right? I got a call from a friend with some highly placed Fed contacts, and they're saying that, hey, I'm hearing that the Fed and the BOJ are basically essentially allowing the BOJ to buy U.S. 10-years to kind of paint a picture to stymie the devaluation of the yen. Okay. And I thought, that's interesting. So you mean kind of like a stealth QE? And he's like, yeah, exactly. So then we saw this massive risk on rally, and then the yen corrected all the way back down to say like 135 or something, right? Then I get a call maybe about a month or two later. Hey, you know what? My people are telling me maybe we can't hold the line anymore. We're going to just kind of have to let it go. Because look, after all, we do have a domestic inflation fight, right? Then the yen just imploded, went to 150, and then we had a violent risk off, right? So that's what I mean. Like, okay, so the Bank of Japan, Japan is one of our key allies. We'll do what we can, but up to a certain extent, because ultimately, right, the domestic inflation mandate is the most important mandate. So right now we're, everybody's been calling the cyclical top in the dollar, and all because people think that we are seeing the sort of light at the end of the tunnel, and that we're almost to our terminal rate. Okay. We may or may not be close to the terminal rate, but to me, that's less important than how long we're going to stay there. I personally think the question isn't so much if the Fed needs to out-hawk the rest of the world. I think the real question is who's going to start out-doving the Fed, because I really don't think that we're going to be in a situation, unless I could be completely wrong. Anything can happen, right? But for me to be completely wrong, this is what would have to happen. The US economy would all of a sudden have to completely take a nosedive, and the rest of the world's economy would hold up in that weird, bizarro universe. I guess it can happen, but I'm not seeing it. I see China flogging its dead horse economy, trying with all its might to revive it, and having a difficulty. I don't see how they do it without devaluing the yuan. I see Japan similarly in a situation where they can't seem to escape that zero bound because of YCC. I see the Bank of England already, despite having 10% CPI, dealing with a flagging economy. And then the Eurozone, same thing, with the added complication of trying to hold a whole bunch of different sovereigns with different economies together. So I'm finding it very, very difficult to accept that alternate scenario. I'll keep an open mind and watch for signs, but I'm not seeing it right now.
Yeah, and you can say there's already a few central banks that have gone that way. So Canada is sort of saying they're going to slow down, and you say, other countries, Australia,
And that's
UK.
right. And I'm glad you brought those two central banks up. And why did they blink first? Because those two countries have much higher percentages of variable rate mortgages, right? So you see, every country has its own sets of constraints, and it just so happens that the U.S. right now, I'm not saying it always will, but the U.S. structurally has a big advantage over the rest of the world right now because, first of all, we're not that export dependent. So a strong dollar doesn't hurt us that badly. Second of all, we don't have that many variable rate mortgages. Thirdly, yes, our debt to GDP is high, but when you consider the amount, the size of the federal balance sheet in relation to its GDP, it's still on the low end, especially when you compare it to countries like Japan. And then when you compare that metric to China, as I just said, my pinned Substack thread explains why that whole metric that China seems to rest upon is a facade. It really is a facade. So I go back to my base case, which is I think that the Fed is not going to stop its inflation fight. It has no reason to. It simply has no reason to. There is no trade-off yet. It's not even in sight yet. You're definitely going to see credit impulse slow down. You're definitely going to see negative feedback loop effects start factoring in, but that trade-off isn't here. And if it isn't here for the ECB, that's what Lagarde said today. She actually said no trade-off between price and financial stability. She said that today. If the ECB is saying that, do you think the Fed doesn't think that, times 10?
Yeah, definitely crazy time. So, Michael, thanks so much for your time today. I really appreciate it. My last question is, what is one message you'd like people to take away from our conversation?
BTFP does not equal BTFD.
I love it. I love the analogy. Awesome. Thanks so much for your time. So you've mentioned Twitter. We've mentioned your Substack. Is there anywhere else people can find your work?
Advertent Twitter suspension. So I'm like, oh shit, I got to hedge myself.
Yeah, you definitely got to spread yourself out. So yeah, thanks again for your time.
Thank you.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.